This week, we are going to talk about how to use commodities to trade Forex. Among the most actively traded currencies, three are known as commodity currencies. They are the Canadian, Australian, and New Zealand dollars. First off, I love to trade commodities currencies. I trade them in the Asia session and the New York session. When volatility in the major dollar-based pairs like Euro USD or Dollar Japanese Yen are low, there can be big swings and even bigger opportunities in commodity currency crosses. My favorite pairs to trade are the Euro commodity currencies, like the Euro Aussie, Euro New Zealand dollar, and Euro Canadian dollar. They tend to move quickly, aggressively, and hit my profit targets easily. I also like trading the Australian dollar, New Zealand dollar, and Canadian dollar against the Swiss franc. They are similar to the Euro pairs with less volatility, and they tend to respond very well to risk appetite along with the pure fundamentals of those countries. I also love to trade the Australian dollar and New Zealand dollar against the Canadian dollar. Why? Because these currencies are pure reflections of how one country is doing against the other. In general, I love trading commodity currencies because when it comes to the majors, when the dollar is involved, more often than not, those currencies like Euro USD or Aussie USD are moved by the market's appetite for US dollars because the greenback is the most actively traded currency, and oftentimes everyone's focus is on the US economy. Currency crosses where you take the dollar out of the equation are much better fundamental trades because they are pure representations of how one country is performing versus the other, and I love to trade relative value pairs. So let's talk about trading. There are two important relationships that we need to cover: oil versus the Canadian dollar and gold versus the Australian dollar. We'll also talk about gold versus the Swiss franc. Canada has the world's third largest oil reserves behind Saudi Arabia and Venezuela. About 8 to 10% of their national output comes from the production and delivery of oil products, natural gas, and electricity. So how do I use oil to trade the Canadian dollar? The principle is simple. When oil prices are rising, it's good for Canadian oil producers, which is good for the Canadian dollar. When oil prices are falling, it is bad for Canadian oil producers and bad for the Canadian dollar. Now, of course, with any correlations, any trading, nothing holds 100% of the time. But as you see in the charts later, it is more often than not that these correlations matter. In fact, when it comes to the correlation between oil and the Canadian dollar, it is much worse for the loonie when prices are falling than rising because the fixed costs of some of these facilities are the same, yet the income of the good that they're producing, oil in this case, is falling. So they're being hit with possibility of net losses. So the Canadian dollar tends to be more sensitive to a drop in oil than a rise in oil. I want to show you how close these relationships are and hope that you understand as well as I do by looking at the charts. In this weekly chart, you can see that there's a strong inverse correlation between oil and dollar CAD. This means that when oil is rising, dollar CAD tends to fall. And when oil, which is the orange line, is falling, dollar CAD, which are the candlesticks, tend to rise. The reason is because when oil goes up, it is bearish for the pair because it drives the bottom of the quote, the Canadian dollar, higher, which is why when oil is up, dollar CAD is down. You can see that there's also a very strong correlation on the daily charts where this rally in oil is corresponding with this decline in the Canadian dollar, and where we have this rally in oil here is corresponding with this decline in the Canadian dollar. This relationship also holds on the 4-hour charts. You can see these things moving in the opposite directions here and the opposite directions here, and pretty much in every case over here, along with the hourly charts, where we basically see oil surging and dollar CAD falling. I actually think that looking at the CAD yen chart gives you a better understanding of the relationship between the Canadian dollar and oil. In fact, this is a very strong correlation as well. So here we have the orange line being oil and the candlesticks being CAD yen. And this is, let's go to the weekly chart first. This is the weekly chart. You can see there's a very strong positive correlation where when oil prices are surging, CAD yen is rising. And when oil prices are plunging, CAD yen is falling. We can see this very strong relationship on the weekly charts, along with the daily charts, 4-hour charts, and the 1-hour charts. So what does this tell us? It tells us that we can use oil to trade the Canadian dollar on a swing and intraday basis. For big trades and day trades, I reference oil all of the time. When I trade North America, Asia, If oil is up a lot in New York trade, I'll look to buy the Canadian dollar versus the US dollar, euro, and other pairs. In Asia, oil doesn't have to move much, so oil doesn't tend to move much. So if there's a very strong move in the New York session, I'll trade based on the premise that CAD will remain strong versus other currencies. The other really important relationship is gold and the Australian dollar. It is not as strong as the Canadian dollar versus oil, and I'll be honest, I trade it less frequently. But it's all still very important because Australia is the world's third largest producer of gold. So let's take a look at the Australian dollar chart. Now we're going to remove the oil price chart. I'm going to add back in gold prices. So we're going to add back in gold. And typically when we do these correlation charts, we have to pin the item to the other axis. So this is a daily chart. The orange line is gold and the candlesticks are the Australian dollar. And you can see there's a very close relationship to these two instruments. And if you look very, very closely, the move in gold often precedes the move in the Australian dollar. And you know, you can see that, you know, basically over here where gold is rallying first right over here. The Australian dollar takes a little bit more time to bottom out, but once it bottoms out, you know, you see that it's following the move higher. Here we have a collapse in gold, which is happening before the collapse in the Australian dollar. And over here you see gold prices pulling back and Aussie is just looking like it's beginning to pull back. And this relationship can also be seen on the 4-hour charts and the 1-hour charts. So it is very tough for the Australian dollar to rally if gold is falling and vice versa. And you know, here we have an instance in the very, very short term, if we look back at the daily charts, where we do have the Australian dollar going up and gold prices going down. And what the historical correlation relationship tells me is that the Australian dollar should fall. There's also a very strong relationship between dollar Swiss and gold. And here you can see that the relationship is an inverse relationship, kind of like dollar CAD and oil, where when the candlesticks which is dollar Swiss, is rallying, you can see that gold prices are falling. But it's actually the reverse, where when gold prices are falling, it tends to correspond with the rise in dollar Swiss. And there's a very strong relationship, which, you know, probably is best seen if we invert this Swiss franc over the dollar. I think it's much more easy for you guys to see how close this relationship falls. Where when gold is rising, you know, the Swiss franc is strengthening. And when gold is falling, the Swiss franc is rising. But in terms of the actual pair, just to get this on your books, gold up, that means dollar Swiss down, and gold down, dollar Swiss up. Now, there's a good reason for this relationship, and it's because gold is priced in US dollars, so its value changes based upon the US dollar's move, which is why we have such a strong correlation. But I think it's also very important to keep in mind because you see how tight these two move alongside each other, the 4-hour charts as well as the 1-hour charts. So if gold is soaring, it's going to be very, very difficult for dollar Swiss to rally. And if gold prices are plunging, it's going to be very, very difficult for dollar Swiss to weaken. I hope you find this video helpful. Watching commodity prices is a key element of my trade selection at BK Forex. I watch oil prices every day as a guide to trade the Canadian dollar. I watch gold prices as a guide to trading the Australian dollar as well as the Swiss franc. If you'd like to learn more about getting my trade ideas every day with precise entries and exits, please visit bkforex.com.